Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's webinar on very important topic, that is key consideration in audit of engineering project, procurement and construction, that is CPC companies. As we all are aware that the topic is very important and the sector is very important, and AASB has already conducted various webinars on industry based. We have covered healthcare sector, we have covered education sector, we have covered NPO sector, we have covered power sector. So today again topic is very important, that is the EPC companies. In order to tackle this, we are having with us very learned speakers here, Yusufi Kapasi ji. On behalf of Auditing and Assurance Standard Board, I extend my warm welcome to you, sir, on this Zoom platform, as well as this webinar organized by AASB of ICI. Welcome to you, sir. Namaste.
Namaste. Thank you very much, sir.
Namaste, sir. I also welcome all the participants of today's webinar. And due to the pre-engagement, due to the sudden meetings of the Honorable Chairman and Vice Chairman, so they have stuck up in the meeting. So we are going to start today's session. So before we formally start today's deliberation, it is my proud privilege to share with all of you the brief profile of today's learned speaker, CA Yusufi Kapasi ji. CA Yusufi Kapasi ji is a member of Institute of Chartered Accountant of India and having more than 10 years of experience in the same. He has a rich experience of auditing various size of clients across the industry like engineering, procurement, construction, pharma, manufacturing, etc. He is a regular speaker and trainer at various platforms and forums and like to share his knowledge and expertise and insights with the other members. He has spoken at various platforms as well as the various seminars and webinars organized by Auditing and Assurance Standard Board and other various platforms organized by the Institute of Chartered Accountant of India. So we are fortunate enough that CA Yusufi sir is with us to share his expertise as well as knowledge on this very important topic. So without wasting much more time, I request today's learned speaker Yusufi sir to please enlighten all of us on various intricacies as well as the key audit consideration on EPC companies. Over to you, sir, please.
Thank you, sir. Thank you very much for such a nice introduction. Hi, good afternoon to all the members, all the participants. I welcome all of you to this session. I thanks ICI for organizing this session and giving me an opportunity to share my inputs and knowledge on this particular topic. So before I share the presentation and I start the topic for today, I just would like to share the couple of thoughts first. Whatever the knowledge and input I'm going to share, that thoughts are my personal thoughts. All the members are advised to take care to apply their own professional judgment while they encounter various practical situations and seek the appropriate guidance wherever required. So today's topic, which I'm going to take care, is the various audit consideration in the areas of or in the industry of engineering, procurement, and construction companies. So before I go formally to the topic, I would like to kind of share an input. This is not a topic, or this is not a kind of an agenda where I'm going to share you a completely technical input in terms of an accounting standards or in terms of an auditing standards. Okay, this is what one of the maybe a different in the webinars that you are going to attend or maybe you are attending in the past. Okay, this is definitely related to the audit, but it is not a completely core technical audit knowledge. What is the reason behind this agenda is basically, see, when you are doing an audit of a specific industry or a specific sector, what my personal experience is, the more knowledge and the more input you will need on those specific industries and a sector, the risk that are pertaining to those particular sector, including the knowledge of your auditing and the accounting skill. So I assume and I understand that all of you have kind of an academic background of the accounting and the auditing aspect. And today, with some of the additional input on the very specific aspect of this industry, the risk in this industry and the overall things that you need to take care while auditing this industry, you will be more confident while you audit the next time the industries or the companies which are pertaining to the engineering, procurement, and the construction sector. With this, I'm going to share my presentation and then I will share the respective slides and the input on the respective slide. I hope my screen is visible to all of you.
Yes, sir. Yes, sir.
Thank you very much. So as I said, our topic for the today is a key consideration in the audit of engineering, procurement, and construction companies. So before we go into the topic and understand the various aspects of this, we have to first understand what is engineering, procurement, and construction contract and this kind of companies first. So as you can see in the first slide, some of the geographical presentation, some of the pictures, this is a construction of the bridge, construction of the national highways, construction of the various refinery plants, various bridges, etc. This all kind of a trunky project fall under the criteria of the EPC contract. If I want to elaborate and give you some more examples, okay, these metro stations which are coming, this bullet train project or the high-speed rail project, which is from the Ahmedabad to Mumbai, this water dam project, the large hospital project, large hospital building constructions, all this kind of a trunky and large infrastructure project are falling under the definition of the engineering, procurement, and construction contract. So this is the brief about what kind of a contract it is carrying. I would like to differentiate this contract with one aspect from the real estate. That is very important and fundamental while you understand and go through this session, because the real estate, the builders and the developer is a different branch of the industry as compared to the EPC contract. What is the real estate, builders and the developer contract? The real estate contract or the buildings and the developer contracts, basically they are constructing the building, the residential unit or a commercial unit, and they keep on selling the individual unit. So that is completely a different industry as compared to what we are going to talk today in the engineering, procurement, and the construction companies. I will take some of the aspect of those also because somehow they are related to the construction. So I will take some additional input on the real estate and the buildings and the developer side also. But our large focus will be on the engineering, procurement, and construction companies. So what is EPC contract? If I want to define an EPC contract is largely divided into the four fundamental principles. The first, the engineering, procurement, and the construction contract are on the most common form of the contract used to undertake the construction work by the private sector on the large scale complex infrastructure. Now, this is the definition. I don't think so that definition need any introduction now because the example is clarifying the definition. The example I say this is a high-speed rail project of Ahmedabad, Mumbai Metro Rail. This National Highway Authority India, this National Highway Road Construction Project, the bridge projects, okay, this metro train projects, all these projects are basically a EPC contract. These are large-scale complex infrastructure projects, generally being floated by the government, the Indian government, through their various public sector companies to the private sector subcontractor. The second bullet point here is, under the EPC contract, a contractor is obliged to deliver the complete facility to a developer who need to only turn a key to start the operating facilities. Hence, the EPC contractor are sometimes called the turnkey construction contractor. See here, what is the difference? Or what is the main agenda? The agenda is they will give us a complete lump sum project that you have to construct one dam or a metro or maybe the hospital, and who is particularly owner of that project just need to start or turn on the key to start the facilities. The third aspect, in addition to the delivering complete facility, the contractor must deliver the facility for the guaranteed price and the guaranteed date. See, the two very important and the critical element of the EPC contract is the guaranteed price as well as the guaranteed date. Since these are the very large project, it can't keep on going for years, as well as it can't be a undetermined price. So these are the two very critical fundamental aspect is the guaranteed date and the guaranteed price. And the last one is that the failure to comply with the requirement will usually result into the contractor incurring monetary liabilities. So in case you don't construct a project on a timely basis, it will have a monetary implication. It will have a liabilities that the basically contractor has to pay, generally termed as a liquidated damages in the construction industry. For any construction contract or any large project, these are the four key principles which you are kind of read, or which I have explained. Is first is that there's a EPC large contract. There's a facility that need to be developed and which need to be start just with a key as a key to start. It should be on. There is a guaranteed price and the date, as well as it bear the risk of any liquidated damages if it is not being done on a timely basis. So these are the four key very pillar of any EPC contract. The tick mark bullet at the end of the slide, it's just for your input, where what we see, this large project like a power project or any other project which we kind of have an example, is commonly referred as a project finance basis, which essentially means that lender are looking for the repayment of the loan from the revenues that are generated by the project. See, if the government has to construct the, let's say, the national highways, okay. So now for the construction of the highways, the government also need a money, which is generally they take it from the banks, okay, and they pay to the contractor. And how the repayment will be done? The repayment will be ideally by collecting the toll revenue, which they are collecting from each and every vehicle which is being passing by. So this is the general model which I am trying to explain, where all this kind of a large project, where the repayment of the funding is being done on the basis of the revenues from those projects. So for example, if the high-speed metro rail, the revenues which will be earned from the metro or high-speed rail, that will be used for the repayment of the loan. So this is how kind of a funding structure defined for this kind of a large EPC project. Now, the next slide represent some of the names which is familiar to you in terms of doing this kind of a contract. Very familiar name: Larsen and Toubro, Hindustan Construction Company, GMR, Shapurji Palanji Group, Gammon, Tata Project. Some of the are Indian companies who you will largely see doing this kind of construction work and the large project work. If you've been around the anywhere roaming around the Delhi metros or maybe the Mumbai metro ongoing construction work, Mumbai bridges work, you will see largely this kind of company's name written while the construction going on. So these are the few very big name in the construction or infrastructure industry in India. If we see the globally, there are some other names, okay, which some of you can relate, is the GE, General Electric, Samsung, okay, LG. All these are also part of the global group. Maybe the Samsung we are largely aware by of the appliances, but one of the major object and one of the major companies Samsung is doing is also the one of the large EPC companies doing the infrastructure project across the global. So these are the companies which you keep on hearing on a recurring basis doing the large construction work. Now, if I want to just brief you on the infrastructure market and the industry in India. So basically, if you heard the budget of 2023, the government focus is largely on the infrastructure development. Thereby, they are floating kind of various project with the size of 100 crore to maybe thousands of crores, okay, where this kind of a project has been undertaken. Many new companies are also entering into the market with the size of maybe 500 crore to 5,000 crore to 50,000 crores. Maybe when I say 50,000 crore or more, maybe the companies like the L&T, etc., who are in the league. But the companies who are having the contracts of the 500 crore, 100 crore, there are many companies which are in the league and doing this construction activities. So with the boom in the infrastructure market, we can see the new subcontractor emerging in India, and thereby the opportunities to do an audit of those subcontractor as well. Now, the next two slides is the heart of the session which I am going to take you today. Okay, why I'm saying the heart of the session which I'm going to take you today? Because this represents some of the key input on the industry as well as the EPC companies' risk profile while you audit these companies. And as I said and mentioned on the slide, is a key risk that goes through an EPC contract. Okay. See, this is very similar to Let's say if you are doing any activity in a very layman word, okay, whether you are driving your vehicle or a car, or maybe let's say you want to do a skydiving, okay, so then maybe you should be aware on what are the key risk that while you carrying while doing this activity. If you know the key risk, you will be definitely able to mitigate those risks, and then you will be able to kind of give enough justice to your audit work as well. So before you get into the audit of this EPC companies, you need to understand the EPC business, and you need to understand the risk around the EPC businesses. The first risk in the EPC business is basically the securities and the guarantees that you need to give while obtaining this contract. So what happens is, if you want to apply for any tender, in the very normal tender ranging from thousands to crores of rupees, there will be always the securities and the guarantees that will be asked while you submit the response to the tender. EPC industry, definitely these big projects are done to the tender, and this is nothing different as compared to the normal tendering. You have to give the securities and the guarantees while you apply for the tendering. So this is one of the very key element in terms of any EPC companies. So now, what is the risk here? Okay, the risk here is that if you fail to perform any of the activities which has been defined in the project or defined in the tender, they might encash your bank guarantees, and that will be directly a loss to the contractor, or maybe there are repercussions around this particular thing. So very important aspect, you need to understand that the securities and the guarantees which are given for obtaining this kind of an contract is a very key and essential requirement, and you need to give enough attention while you audit this kind of an companies to the securities and the guarantees we have given. Now see, what happened is, this kind of an guarantees and securities are like a performance guarantees. Okay, so basically I have to give a guarantee to ensure that I will perform this work. Now, when we read the accounting and the auditing literature, this kind of a guarantee are not required to be recorded by way of the debit, credit, and trade. You have a banking facilities, and this will be issued. So it will not come anywhere in your balance sheet, anywhere in your statement of profit and loss, or anywhere in your contingent liability also, because the contingent liability itself required us to exclude the performance bank guarantees. So it is very important for the auditor to understand how many guarantees are given, what is the volume, and how that contract are working. Otherwise, the moment these guarantees are encashed, there will be a very huge risk that we are carrying on the this kind of an auditing companies, as well as the company itself on their overall balance sheet. Permits and approvals. Now, I will first explain through this example. Okay. Now, let's say the government is doing a work of this high-speed train from Ahmedabad to Mumbai and vice versa. Now, see, the land which is required to construct this particular high-speed rail is not readily available in terms of definitely the land is there, but it is occupied by one or another person, or it is owned by somebody else. So government has to go to the individuals or the companies who are owning that, identify the rights that, pay for that, take approval, and then construct the high-speed rail. So what happened is, this is a lengthy process, and you have been hearing in the newspaper also saying that the metro high-speed rails projects are sometimes delayed because of the permits and approvals that need to be obtained. Now, this is very critical for the EPC contract as well as the companies, because any delay in those processes or a permit or an approval can result into the delay in overall contract execution, as well as the additional cost that we need to incur. There is also a risk that how much amount we need to pay for this approval, because let's say if I am owning a farm, okay, and I have a crop which is the live crop on the farm, the amount that the farmer will ask, I'm not sure as of now, as well as that depends upon the prices of the crop. So there is a various risk in terms of timing, in terms of cost, all this risk attached while you kind of obtain this permits and approval. Third one is the price risk. Okay. So basically, see this trunky project. Okay. Let's say if I have to give a project, okay, I will always prefer that to be a fixed price contract. Because see, if let's say if the construction of the bridge need to be done, okay, then there are various elements in the bridge construction, designing, procuring various material, construction, approval. So then the cost can go X, X plus Y, X plus Z, X plus Y plus Z. So I always willing to be a fixed price contract, but thereby the contractor is in a fix, where if the cost increase, their profit is decreasing or the margin will reduce. So the contract, which are a fixed price contract, is carry a huge risk of the margin loss in case of a delay or additional cost, where the contract, which are the variable price contract, having a lesser risk of the margin loss of the profit loss. So as I said, this is the first slide of the risk that we need to understand as well as the take care while auditing the EPC companies. These are the three fundamental risks. I just keep it open for a while to read on the slide whatever I have written, maybe 30 seconds or so. If somebody wants to note this risk, they can also note it, and then I will move to the next slide where the another risk or another categories of the risk are being identified. But these are the two slides which is the heart of the overall session on the risk, which is the EPC contractor. And while as an auditor we audit the EPC companies, we are carrying if we miss to look out on those aspects. I understand the question answer session will be the end of the webinar. So if you have any question, you can keep it note, and then at the end of the session, we will take your questions as well. The next category of the risk is the subcontracting risk. Now, see, when the EPC contractor undertook the large work of the EPC, if the large infrastructure project, it is not possible for the single person to execute the overall 100% project. So definitely they have to rely on some small subcontractor. Now, see, when you are working with the customer, let's say for the 500 crore project, you understand the various responsibilities, risk, and the quality of the work you need to deliver. But let's say you are given a subcontractor of 5 crore rupees of work to your ex party, they might not be vigilant about the overall 500 crore project. Okay, so monitoring the responsibilities and the compliances, the quality of the work of the subcontractor is the responsibility of the main contractor. Where let's say you are working with more than one subcontractor, it is very important for the main contractor to ensure that they deliver as per the expectation in terms of the qualities, in terms of the responsibilities, in terms of the overall output of the work is required. The next risk is the completion risk. Now, the completion risk is somewhat basically if there is a delay in the completion of the project. As I said, there will be a liquidated damages that need to be paid for the overrun. Now, see, any main customer will keep a clause saying that if the project got delayed, there will be a deduction. So, since these are the complex project and the completion is a very important, so that's why there is need to be a very strong mechanism to ensure that the project complete on time. Otherwise, be ready for the liquidated damages and the penalties that we need to pay, and which will reduce ultimately our profit. So if you are auditing the EPC companies, you need to be very careful in terms of and whether the projects are on time or not. Okay, otherwise there will be additional losses and your profitability can reduce. Extension of the time and additional cost. This is somewhat linked to the earlier risk of an completion, but here maybe I can additionally clarify. Okay, there are the extension of the time which is given by the customer. Like say there is a COVID. Okay. Now during the COVID, there's nobody able to work. Okay. So this is called the force majeure condition. So this kind of and clauses are there in the contract, and if this conditions comes, the customer on a very upfront basis has to notify to the EPC contractor on a very upfront basis to notify the customer about this and ensure that they get appropriate extension of time. If you don't get it, it will be considered as a delay, and the delay has an additional implication on the damages, penalties, and the liquidated damages. Performance risk. Okay. Now, see, this kind of a project, which are a very huge project and the large infrastructure project, come with a lot of responsibilities to deliver the project with the right technology and the quality. Let's say there is a bridges where, let's say, thousands of people keep on kind of and moving during the day. Any kind of an deviation in terms of their quality or the desired technology or desired kind of an output can be damaging to the lives of the many people, as well as the damaging to the in terms of cost as well. So there has to be a proper performance by the EPC contractor in terms of the quality and the technology which they are using to deliver this kind of a contract. The defect liability in the layman language is a warranty. Okay. So this kind of a contract by default comes with the warranty clause, where the maintenance related aspect as well as the any defect in the project which the contractor has executed for the limited period of time may require the contractor to rework on that. Okay, it's like a very similar to thing where you buy any XYZ from the market, it comes with the warranty. This kind of a project also comes with the warranty. The kind of a good work and the quality work you will do during the execution, the lesser you will spend on the warranty. Otherwise, you are likely to spend higher on the warranty. So this is also the risk that the contractor is carrying. As an auditor, we need to keep in mind that if there are any risk around this, there are appropriate warranty provision that has been made. So these are the additional 5 risks, the 3 risks we have seen in the previous slide, and this 5 risks, which are the major risks while you do kind of any audit of an EPC contractor or EPC companies. And this we have to mandatorily take care while we do any audit of the EPC companies. So as I said at the beginning of my session, it's not of an accounting knowledge or auditing knowledge that I want to bring on the table. It's not only the accounting and auditing knowledge I want to bring on the table, but these are the key industry related input, which as an auditor, we need to keep in mind if we are auditing a EPC companies. I will give a 1 minute if somebody wants to note down this particular risk or note down any questions which they want to discuss later in the second phase when we take the question answer session. So maybe 30 seconds to all the participants to read through the slides. The next slide, as you can see that we have seen the risk. Okay. Now I have tried to highlight some of the direct audit implication of those risks. Okay. So now you have to link those risks with the implications on the audit, because definitely those risks we have discussed, because that has a audit implication if you don't understand those risks properly or don't evaluate those risks properly. Securities and guarantees, some of them we discussed. So I will say that the risk is encashment of the bank guarantee. So if we don't perform on the contract, they will encash the bank guarantees, the loss. Inappropriate encashment and then litigation. So what happens is you will say, no, the contractor will say that, no, we have done our duties properly. The customer will say that, no, it's not been done and we have encashed your bank guarantees. And then it run into the litigation. And the litigation has an additional cost to both the parties in terms of lawyer fees and other ancillaries cost. Additional effort and the cost on the litigation and the cost of interest on the block fund, because your fund is blocked. Now the customer will not pay you any receivable, customer will not pay you additional money, your encashment also result into the additional outflow, your fund are blocked, interest cost on those block funds. So these are all the basically output, or basically the implication if the securities are being encashed, and you need to be very mindful in terms of how many bank guarantees and the securities are being issued. Permits and approvals. What is the implication? Additional time in case the approvals are delayed. Definitely the approvals are not in time, though additional time will be required. There will be a time lapse and the project will get delayed. The cost of obtaining approval is uncertain, can lead to the additional loss in the contract. This is very important, guys. See, now I will clarify. In the large project, some of these permits and approval is in the responsibility of the customer. Let's say if the government want to do a high-speed rail between the Ahmedabad and Mumbai, the majority of the part, which is the land, which is owned by the government, or maybe the government will push the clearance on this land. Okay, so thereby some of this is sometimes taken care by the customer and not the EPC contractor responsibilities. But if it is not taken care by the customer, it's a EPC contractor responsibilities. Generally, these are well defined and well written in the contract, and accordingly, this need to be taken care either by the customer or by the contractor. And this is very uncertain. Additional cost can result into the additional losses. The price risk. The price risk, as I said, the fixed price contract, if result into the losses, is cost is increases. Let me give you an example. Let's say if you are constructing a bridge. Okay. Now let's say when you are constructing a bridge, it will require a huge amount of the steel. Now let's say after the COVID, when there is a kind of a shutdown in the China for the steel production, there is a huge demand in terms of steel which is came, and the shortfall in the production, and resultant is what? The steel price is increased, and thereby, let's say if you are constructing a bridge and the steel price just shoot up, you will be end up losing, making additional loss, because your overall price to deliver remains same. But if you have a variable price contract where your price is based on, let's say, your prices of the underlying material. So some of the contract is having a clause, let's say the price of the metal is X, then the price or the revenue the customer will pay is X plus 5% margin. And let's say if the price increase from X plus 10%, then your revenue will also increase from X plus 10% plus additional 5% margin. So it's always better to have a contract in place which are based on the variable prices or based on the variable clauses rather than the fixed price contract. So look out for the contract if your audit client is working on the fixed price contract. What are the additional audit implication of some of the additional risk consideration? First, the subcontractor audit implication is the monitoring the quality of the work and performance of the subcontractor. Availability of the subcontractor can also be a challenging sometime. And the most important audit implication is the ensuring that the subcontractor comply with the laws and regulation. See, what happens is sometimes subcontractor feel that, okay, I am doing a very small work of, let's say, 2-3 crore. Nobody is going to watch out for me. They will not comply with the PF laws. They will not comply with the labor laws. They will not comply with the safety laws, not comply with the other laws, GST laws. And then maybe the burden of that non-compliance can ultimately come to the main contractor. So any work which is allocated to the subcontractor, the laws and the regulation compliance is very important and to be taken care by the main EPC subcontractor. And that is the very important audit step that we need to take care while we audit the EPC client. The completion, the delay, as we discussed, result into the penalties and the additional liquidated damages as a part of your audit application. Extension of time. So what happened is you have to watch out for, or you have to take care, the audit client has a appropriate mechanism to monitor and kind of ensuring the appropriate responsibilities for the project extension, and that has been assigned to the right people. Otherwise, they will make a losses, since, let's say, as I said, in the COVID, because of the force majeures kind of an event, you just need to intimate a customer and then the additional time will be allocated. But if you don't intimate only, then it's a loss to the EPC contractor. So whether the audit client of yours, whether the EPC contractor is appropriately intimating the additional time or the extension of time, it is very important. Performance risk. Any issues in the quality of the work, definitely it can result into the additional payment and discontinuation of work, litigation. All this is a audit implication. And the defect liability, as I said, if you are not if we have not delivered the work up to the right quality, there will be an additional provision that will be required for the warranty, will be accounted in your balance sheet as well as the statement of the profit and loss. So this is the slide, colleagues, where we discuss that these are some of the risks which we have identified in the EPC business and the direct audit impact of those risks, how it can impact your profitability, how it can impact your overall balance sheet and the statement of the profit and loss. So let's say if we are doing any audit, okay, any XYZ company, any XYZ industry. So we know that there will be an audit, basic things required to audit. But these are the last 40 minutes. What I have been discussed with you is a unique to the engineering, procurement, and construction industries. So I will just take maybe 15 seconds or so to read this slide, and then I will move to the next slide. See, as I said, the heart of the session is what already we discussed, is basically the EPC sector and the risk around this. Now I have to explain some of the accounting and the auditing aspect around this. So that I will start by giving you some basic understanding on the revenue standard, which is Ind AS 115. Okay. Now with this new standard Ind AS 115, the revenue recognition has been divided into the 5 steps, okay, which is the written here on the slide, which is 1, 2, 3, 4, 5. I will explain you briefly these steps, and some of these steps are also explained in the next slide in terms of their additional parameters. So what are the 5 steps? The first step is the contract with the customer. See, you have to earn the revenue, there has to be a customer. The first step is that you should have a contract with the customer. So there has to be a customer, there has to be a contract. This is the first step. Second, identify the performance obligation. Now, nobody is going to pay you without you are doing anything. So there has to be some service, there has to be some product. So there has to be some obligation, okay, of the service provider or the product provider. So it is called a performance obligation. So for example, as a chartered accountant, we are doing an audit. So audit is our performance obligation. Third step, determine the transaction price. Okay, definitely, if we are doing an audit, we will charge fees. So that fees is called the transaction price in the accounting language, where we are falling under the Ind AS 115, and we are seeing that the third step in the revenue recognition is the determining the transaction price. That means agreeing our fees with the customers. Fourth, allocate the transaction price over the performance obligation. Now, this is the little bit technical word, where you have to allocate the transaction price for the performance. Now, if I want to explain in the simple terms, let's say as a chartered accountant, you are providing 2 services: filing a return of income, okay, and second is the doing some kind of an audit work or the internal audit. Now, let's say you are doing an internal audit and filing a return of income. So then there are 2 obligations. So then if you have agreed the fees with the client, you have to proportionate the fees also with these 2 services. So that is the 4th point, where you allocate your transaction price, that is mean your fees, to your performance obligation, that how much is linked to the internal audit, how much is linked to the return filing. So then this, you need to identify your obligation separately and allocate the fees separately. Recognizing the revenue as and when you performance obligation satisfied. The moment you close or we deliver the respective obligation, you recognize your revenue. Some of these we will see that how it is being done for the EPC companies, that we will see in the next slide. But these are the 5 steps whereby the revenue is recognized currently, which is based on the Ind AS 115. In the accounting standard, the revenue is recognized on the basis of the transfer of the substantial risk and reward, which is kind of a more simpler in terms of an recognizing of the revenue. But when it's come to the EPC companies, we will see that how it differentiate under the accounting standard and Ind AS. Under Ind AS, these are the 5-step model by which you need to recognize your revenue. So I have not explained all these steps, but few critical steps in this I have explained because the focus is on the EPC companies and their aspect rather than the accounting standard or the accounting standard 115. But the next slide will give you some of the additional input in the performance obligation. See, first step, very simple. We have a contract, we have a customer. Second step, performance obligation. So this is the scenario which you are going to study, and then we will understand what is performance obligation. Company A is an auto component supplier and supply auto parts to a original equipment manufacturer. Now, company A is an auto component supplier and supply the component to the OEM. That means, let's say there is a company A who is supplying to the OEM. OEM means what? Like the Honda is a OEM because they are manufacturing the original equipment. Okay, so the Honda hai, Hyundai hai, Tata Motors hai, all these are called OEM. Now, as we say, the company A, auto component supplier, supply a product to the OEM. It has received a contract to make a tool for a consideration of 5 lakh. Now, they have received a contract to make a tool with a total price of 5 lakh. The tooling also required a design to be created and approved from the customer, and the process of manufacturing of the tooling will begin. The process is completed in a short period of time, let's say around a month. Whether the design and tooling are the separate performance obligation or not. See, the question here is to what is my performance obligation? मुझे design करना है, मुझे tool बनाना है, क्या करना है? Okay. By reading this question, it is appearing that we have to build up a design also and we have to give a tool also. But then when we read in terms of an accounting standard, okay, Ind AS 115, Ind AS, so then it's what? What is my performance obligation? It's definitely overall tool, or these are the two separate. One is a design and one is a tool manufacturing. So let's see. If the design activity and the tooling activity are satisfying the above stated indicator, that is to say, the designing is highly interrelated with the tooling activity. The designing is complex and specialized. Such a customer cannot derive any benefit from the independent tooling activity. Then both design and tooling is a single performance obligation. See, now, if I want to explain you in the chartered accountant language, let's say you prepare a computation of income and then you file a return. So ultimately, customer is benefited from the overall filing of the return of income with the compliance. Computation banane se customer will not be benefited. Okay, they will understand there's a computation. But then ultimate outcome is the return of income that need to be filed to comply with the laws and regulation. So then in this case also, the ultimately customer want the tool to be manufactured. Usko khali design se matlab nahi hai. So the only service is the overall one service, which is the design and manufacture. Let's say if the customer is given a contract to build a bridge, okay, construct a bridge. So bridge ka design is not a overall service. The service is the design, engineering, and the construction, EPC. So that is called a one performance obligation. The reason to give you this example for performance obligation is that whenever this kind of a mega project is there, there will be only a one performance obligation in the project, which is you have to deliver the complete project. Just to give you a different flavor in this example, however, the design activity, let's say, is not highly interrelated. And design is also not complex. And company provide designing on a standalone basis to all the customer, then the designing and the manufacturing will be separate performance obligation. Let's say the customer has an always option designing, doing this, and then doing a manufacturing. They are selling the design also separately. Okay, customer can take the design and get it manufacturing by somebody else also. It's very simple design. Somebody else also can understand and manufacturing the tool on basis of design. Then it's both are a separate performance obligation. Otherwise, it has to be only a single performance obligation. So keep that in mind. In the EPC business, the large projects are likely to fall under a one performance obligation. Okay, the simple activities are falling under the different performance obligation. So what we understood, the contract with the customer and determining the performance obligation or identifying the performance obligation, which is the serial number 2. Now, see, I'm not going much into the accounting standard, but what is the revenue recognition method? How you recognize the revenue? Okay, specifically in the EPC business. Okay, when we talk about the standard has a 2 method, which is the percentage completion method, or under Ind AS it is called the input method, or the completed contract method, unit deliver method, or under the Ind AS it is called the output method. Now, see, you have to apply a judgment to determine the input method or output method. And you have to always first assess whether the input method is possible or not. First, you have to see the input method and then only you have to go for the output method. So what is written here? Let me read it. So Ind AS and AS permit 2 methods of the recognition revenue. Over a time, often referred to as a percentage of completion method or using the input method, and the output method, which is the unit deliver method. Entity should select the method which is the best depict the transfer of control of goods and services. An example of each is given below. First, input method. Input method, how the revenue is determined? Let's say it's a fixed price contract, which is outsourcing to a customer over a 2 year with a price of £1 million. The total estimated cost of the project is $5 lakh. Anticipated margin is 50% because we have a revenue of $1 million, £1 million, cost of £5 lakh. So the margin is 50%. At the end of the period, the entity incurred the cost of £2 lakh. So total cost was 5 lakh, incurred a cost of 2 lakh, which is 40% cost you have incurred. So then how you recognize the revenue? Your total revenue is 1 million, and 40% is what you have completed. So you'll recognize the revenue of 4 lakh. So this is called the input method, and this is the method which is used for the EPC contract where there is a one performance obligation. So just keep this in mind, note it. This is the method, percentage of completion method, which is termed as an input method, which is being used for the revenue in case of an EPC contract. Output method. A fixed price contract which is signed to manufacture and deliver 50 items of an equipment of 1 million. See, in the output method, it's like a basis on your output. Okay, it's like a product you have to deliver. 50 items you have to deliver. One item, 20,000 pounds. So 50 items, 1 million pounds. So whatever item you will deliver, you will recognize revenue. Let's say at the end of the year, you have delivered 5 items. So you will recognize the 20,000 into 5, which is 1 lakh pounds. Very simple. What we used to keep on doing for the manufacturing industry, trading industry, we used to do the same. So output method generally not apply for the large infrastructure project. As I said, the first you have to evaluate the input method. So Ind AS 115 gives some criteria that if that criteria is satisfied, you have to always use the input method only. And the EPC contract will generally satisfy those criteria. What are that criteria that we are going to see from the Ind AS 115? Sorry. The customer simultaneously receive and consume the benefit provided by the entity performance and the entity perform. Let's say, is there a contract to construct a bridge? So then, what is the criteria? When you do an input method, when you do a POC method, the customer receive and consume the benefit. Is it possible? Not possible. See, one of the criteria need to meet. There are 3 criteria. One word reading. See, if you are constructing a bridge and bridge is not complete, nobody can receive the benefit. Okay, because the bridge is in construction, is in progress. So this criteria is not met. The entity's performance create, enhance an asset that customer control as the asset is created or enhanced. Okay, that means if I am constructing a bridge, that gives an asset to the customer, or it enhance the asset for the customer. Now let's say I am constructing a bridge. How it will enhance the asset for the customer? Customer is interested in the overall bridge from point A to point B. If it is left in between, it will not be useful. So this criteria not likely to meet. Third criteria. The entity's performance means the contractor performance does not create an asset with an alternative use. And the entity has a right to payment for the work which is completed today. This is very important criteria met in 99% of the infrastructure project. What happened? There's no alternative use. The bridge is used from point A to B. There is only one use. Okay, it can't be used for any other person. वो ब्रिज को वहां से उठा के हम कहीं और पे तो नहीं ले जा सकते, ना वो आधे अधूरे ब्रिज का कुछ कर सकते हैं. So it does not have any alternative use. Second, always this kind of a contract has a right to payment, because if I'm constructing a bridge from A to B point, which is let's say 100 kilometer or let's say 10 kilometer, I need a payment in between. I cannot survive with a payment at the end of the project. Okay, so generally this kind of a project is a criteria to get a payment on a recurring basis, and that's why this criteria is met for most of the EPC contract. And if this criteria is met, you will use the input or a POC method. It's a bit technical slide on the revenue recognition model of the Ind AS 115. I will keep it open for maybe 1.5 minutes. I request all the members to read it. Moving to the next slide, this is the kind of a mathematical example which will help you to understand this aspect. Let's say there is a large EPC project, and this is the project with a total revenue from that project of 100. The total cost for this project is 65. Okay, and assumingly the profit will be 35. Now, what happened? This project is not likely to completed. All this kind of a large project is not likely to completed in a year. And we assume that the recognition for the percentage completion method criteria fits here, as we will get the payment also recurringly basis, and there will be no other use of this asset. So what happened at a year one? Let's say you have incurred the total cost of rupees 30. Okay. So then what happens? So this is the first serial number in the table 2 is, let's say you incur the total cost of 30. 30 means you have actually, let's say you are constructing a bridge. For the construction of bridge, you have spent the amount on the material, spent amount on the labor, and the total amount is 30. Okay. Now, what is the percentage of completion? Is your total cost which you have incurred, which is 30, divided by the total cost of the project, which is 65. That means you have completed the project up to 46%. Okay, which is 30 divided by 65 into 100, 46.15% project is completed. So how the revenue will recognize? What is the total revenue? Total revenue is 100 into what is the percentage completion project completed into 46.15 is equal to 46.15 rupees of the revenue that will be recognized in my income statement. What will be the profit? Let's say this is the only project in the company. So the total revenue recognized in the serial number 3 is 46.15 minus cost incurred is 30. The profit will be 16.15. Now, two additional aspects. Let's say, because you will keep on billing it to the customer, so you have already raised an invoice to the customer, and you have raised an invoice of 25. So the 25 rupees will be your revenue, which is invoice raised in the balance sheet. It will be your debtors. Now you have total revenue recognized is what? 46.15 minus the unbilled amount is what? Minus you have invoices raised is how much? 25. So balance 21.15 will be your contract asset in your balance sheet under Ind AS 115, or it will be your unbilled revenue. So this is how the mathematical function will work in the EPC business to recognize the revenue. So important aspect here is that how you determine the percentage of completion, okay, and whatever you have not billed it to the client will be considered as a contract asset or unbilled. See guys, very important point here is that your profit is 16.15 in the year one, which is your revenue 46.15, which is your revenue 46.15 minus your cost 30. How this 46.15 came? It's 30 divided by 65, and 65 is your total estimated cost. Now, the same example, guys. This is the slide, another slide where your total cost is 55. Here is what? 65. Now it is 55. So what happened? Total cost incurred, because actual kharcha hai wo to same hi rahega. Okay. So that will be 30 only. Percentage of completion, it's 30 divided by 55, because your total cost you have estimated is 55. Okay. So your percentage completion will be 54.55. What is the revenue to recognize? 100 into percentage 54.55, total revenue 54.55. Kitna profit ho jayega? Which is total revenue 54 minus 30, 24.25. So what you need to notice here, guys, depending upon your total estimated cost of the project, your profitability can significantly change. So you have understood all the risk which need to be taken care in mind while doing an audit of the EPC company. The very important and the fundamental aspect in the audit of an EPC company is the total estimated cost. Because see, let's say if I'm an auditor, I'm auditing the large construction of the bridge. Now there is a limited input or the limited expertise I can apply on the total cost. Client will say that I have to build so much amount of the square feet, I have to do this kind of an cabling, I have to do this kind of an work, this kind of an work, total cost is X. I have to apply all my input while auditing this kind of a numbers, but then beyond the point it is a limitation. And the total cost will play a very important role to determine your profitability, because the client will understate the cost. If the client wo cost ko kam rakhega, okay, so then it will be a higher profit than it is recognizing. Okay, so then you have to be very mindful while auditing the total cost number, because if this number is incorrect, your complete P&L can go wrong. So no doubt this total 55 number of the cost estimation will not come anywhere, but it will ultimately determine your profit and loss in the statement. So cost to complete, as I said, what I was explaining, this is the key contributor to the margin that is anticipated on the contract as a whole, which then drive the amount of the revenue and margin, what is to be recognized for the particular period where POC accounting is used. The component would generally be expected to represent a significant risk in the main area where the potential management bias and error in the estimation process. See, this will be a significant risk while you audit. Okay, because what happened is if you don't audit this particular aspect properly, it will completely miss calculation of your revenue and the profit that you need to recognize in the statement of the profit and loss. So be very careful in terms of how you audit the cost to complete. The principal assertion likely to represent a significant risk in the completeness, accuracy, valuation, and the overall completeness process. The cost to complete, accuracy, valuation, and completeness process. So you have to be very careful, guys, because this is the most important element which will drive your statement of the profit and loss, your income, and your profit in the particular EPC company's profit and loss account. So cost to complete, very important. I'm just keeping it open for a minute, guys. This slide to understand and digest is the mathematical aspect. Now, see, we understood that there are risks, okay? And we understood that there is a cost to complete, there are various risks attached to the subcontractor, etc. So, what control you will check? Now, as an auditor, when you audit this company, so maybe you have, I will explain this way. I have explained you in terms of, and these are the risks. But now, जब audit करने जाएंगे तो check क्या करेंगे? Okay, so what key control we will check? First, the tender review and sign off before bidding. Okay. So what happened? Let's say if you have to bid for the project, it is very important that you understand how the management or the audit client is doing a tender review and sign off. Because if the tender has not been properly reviewed, you might have taken the work which you are not expert or maybe at a price which you are not comfortable. So whether management has a control for the tender review or not. Second, the management process of the legal review of terms and condition of the contract. See, the contract is a very bulky document. As the audit client is checking all the terms or the legal team is checking all the terms and condition of the contract. Okay, if not, it can create a kind of a great risk on the performance of the R duties in terms of an EPC contractor, as well as the client may take some of the contract which are not legally favorable to them. Third, recurring review meeting during the execution of the project and monitoring of the progress of the project. See, this is very fundamental and the layman aspect. For any work which is ongoing, you have to review ongoing basis. So if we are doing a very mega project, how the client is actually doing the execution of the project and the monitoring of the project on a recurring basis. Are there monthly meeting, fortnightly meeting happening? They are reviewing the progress of the project, obstacle of the project, and how they are taking care. Because all this meeting will help them to reduce the risk which we have discussed in the initial slide. Fourth, how the management communicate the escalations and the delay in project on a timely basis. Discuss with the client for the extension of the timeline. Management, if there are delay in terms of their approvals, in terms of a land approval, is the audit client is properly discussing the extension with the customer or not? There is a control around this or not? Very important to check. Formal sign off on the financial position at each period between the operational and finance team. Very important, colleagues, because see what happened is now operational team will have their own knowledge and input. Okay, and finance team will not be aware in terms of what is happening at a bridge. They will be always aware in terms of what is happening in terms of debit, credit, and the numbers and the accounts. They are not aware in terms of what is happening and issues at a bridge. Okay, if we are constructing a bridge, then the both has to sit together, identify the challenges, and then translate into the accounts if there are additional losses to be booked, additional costs need to be booked. So while as an auditor, we need to ensure and we need to find out what is the management control to ensure that the operation and finance teams are on the same line. With claim of the additional price where there is a variation clause. So if there are variation clauses in the contract, how the audit client or the EPC contractor is going to the customer and asking for all the variations and the additional prices. Intimation of any force majeure condition to the client as required. We discussed like a COVID scenario, whether the EPC contractor is appropriately mentioning the force majeure condition, etc., to the customer or not. And the review of budget versus actual margin. So let's say in our example, if we have estimated total cost of 65, are we end up doing 65 or a 67 or a 60 or a 75? That review has to be done, and the reason for that need to be identified and accordingly need to be taken care for the future bidding. So these are the key control colleagues that you will check. You will expect any of the EPC contractor while you do an audit to ensure that they don't miss or they don't get into the any kind of surprises, any unmanageable risk. If the client does not have this kind of controls in place, it is very difficult to I will say, the audit the EPC contractor or the EPC companies. I'm keeping it open for 30 seconds to read this control, and then I will move on. The next topic, guys. Now you have identified which control you have to take. Okay. Control you have to test. Now, what contract you will select? Okay. See, you have to do the controls also and then auditing the respective contract also. So contract, if you want to do an audit, first of all, you have to select the contract. Okay. Select the contract means there may be a more than one contract that EPC contractor is doing. Okay. So then you have to select the right contract. Okay. And how will you select the contract, which is depend upon the factors which is defined here. Let's see, read it one by one. The first is based on the review of the appropriate terms of the contract. Let's say if you see that there are some unique terms in the contract which are entered by the customer and the audit client, which is the EPC contract. Then you have to select those contracts, considering that how the client is basically taking care of those specific or unique terms and condition. The size of the contract which are kind of an very large in terms of their size, the kind of contract which are entered during the year and which are contributing significant amount of the revenue, those contract. Selection of the contract based on the project managers and the review of minutes of the discussion with the operation team. So what you have to do as an auditor, go to the project managers or maybe any operation team, understand from them which are the complex contract for them. Okay, because with the discussion of them, we will be able to realize that these are the complex, or the operation team, these are the very complex contract, or in terms of there are any challenges in this contract, etc., etc. Review of the legal and professional fee to identify, is there any contract where they need a help of the legal advisor? If yes, so then there might be some issue on those contracts, pick up those contracts. And last contract which are involved the multiple subcontractor, multiple location, multiple geographies which are higher than the normal risk. So see, let's say if the client is doing a 50 contract, you can't audit 50 contract. You have to pick up few contract and you will pick up on the basis of the criteria which is defined here, like maybe the contract based on the terms and conditions, size, revenue contributed, any issues, legal issues, as well as the multiple subcontractor, location, etc., etc. Since we understood the risk also, we understood the control also, we understood we have to pick up for the audit also, I have highlighted here some of the reason why there is a failure in the EPC contractor. So these are the quick input on the why there is a failure, because the EPC contractor don't evaluate the contract profitability on the realistic basis. There is an inadequate control or the estimation and the bidding. See, this is very important to have a right process on the estimation, because if you don't estimate the cost properly, you are going to lose very huge kind of an out of the EPC contract, because once you commit for the contract, you can't come out. Okay, it's not like a product where you will sell 1, 2, 5, 10 or 20 item of a product. It's like a very huge infrastructure project. So estimating the project cost is very important, and then only you can bid for the right price and getting the right profit. Inadequate contract cost record, weakness in the billing. This is very important. See, if you don't bill your amounts to the customer, because if you are doing 500 crore project, you have to keep on billing and collecting. If you don't bill it properly, you will not collect it, and huge roadblock of your fund. Inadequate control on the construction equipment, construction adequate cost records are not appropriately maintained, poor control on the job site of the payroll and other disbursement. See, because these are the remote site, various locations, it's very important to keep a control on your equipments, your payrolls, your payment to laborers, etc., etc. If you don't take care of this, there are major reasons that your contractors is likely to make a losses, or a contractor may result into the failure to perform the duties. So if you're auditing a EPC contract, watch out for this particular activities, how the client is managing this. Now, if you ask me, I have explained you what control you will check, how will you select the contract. Now it's a time. Now you selected a contract, what you will audit. Okay. So what you will audit? First, you will audit the original contract. You will read the original contract and you will identify what is the overall contract value to the signed contract. Second, If there are any variation, as I said, there might be a variation in the prices, and accordingly your overall price may vary. So check those variation with the supporting document, the customer change notices, client certification, independent quality surveyor report, and the customer correspondence. So if there are variation to the price, let's say I have entered into contract of 100, but because of the design change, layout change, the route change, etc., the price might change. So audit those changes. If there are unagreed variation, the disputed variation claim should only be recognized where the client believes they have a contractual entitlement as a result of the instructed variation, and they are able to demonstrate that they are in advanced stage of negotiation with the client, which will result in the successful settlement. See, sometimes it happens that because of the large, let's say if I'm constructing a project of the metro rail from Ahmedabad to Mumbai, I have to do certain variation in terms of en route, etc., and which I have to bill it to the client as well. Okay, if there are additional costs, but that need to be recognized as a revenue only when the EPC contractor is confident that it will be realized and it will be settled. If there are liquidated damages on the project we are expecting because of the delay, that need to be taken care, and how that is addressed by the audit client or the contractor, that need to be verified. So basically it can be the expense to your P&L, or it can be directly reduction in your revenue as well. We'll see this example, one example from the Ind AS 115 on the liquidated damages, so you will understand it better. And any provision for the defect liability period, which is the warranty, how the client has recognized it. So while you audit the revenue, in addition to the control, you have to see the original contract value, any variations, any any unagreed variations, any liquidated damages that client need to account for, and any warranty provision the client has to do. See, I am not getting into the integrity of the accounting of all this, but are the key parameters which the EPC audit client has to take care, and the EPC audit auditor has to watch out while doing an audit. So there are the accounting of implications around this, but these are the pointers we need to take care while doing this. Couple of them I will explain them, liquidated damages, etc. I will explain you in the further slide. So these are the 5 steps which you need to ensure while you audit the revenue. Now, this is one of the examples. See, there's one reporting, which is the key audit matter reporting. Many of my colleagues will be aware there is a standards on auditing on the key audit matter, where all the listed client has to mandatorily required to report. Listed client auditor has to mandatorily required to report on the key audit matter. Okay. Now, if you read any EPC company's audit report, generally the revenue overall is always part of the key audit matter. I have taken this key audit matter from the L&T, which is one of the largest EPC company in India. And they have written very similar thing, what I have been trying to explain you in the last 1.5 hours, so that we will just read it in terms of what they are writing in their key audit matter. I will read it out for you, and I will keep it open to you to read as well. So what they are writing, starting with the first bullet point, the significant judgment are involved in determining the expected losses when such a losses are become probable based on the expected contract cost. They are starting with the significant judgment on the contract cost. As I said, the contract cost is very difficult element to judge. So they are writing and highlighting to the reader that it is a significant judgment are involved in the expected cost estimation. The cost contingencies are included in this estimate to take into account the specific risk of uncertainties of the disputed claim against the company arising within each contract. They have also kept the certain portion of the additional cost as a contingencies because there might be a additional cost required. See, let me give you an example of this contingency. Let's say you are constructing a bridge. Okay, now the bridge is above the river. There is a heavy rainfall, and generally the rainfall parameters are not that high in the last 5 years. In the current year, you are having a heavy rainfall, and because of your work is stopped for, let's say, 6 months. So these are the contingencies. For that, you have to keep the additional costs. So that is what they are trying to explain here. The next point, the significant judgment are involved in determining the expected losses, and when such a losses become probable based on the expected total contract cost. Cost contingencies are included in this estimate to take into account the specific risk of the uncertainties, and these are reviewed by the management on a regular basis throughout the life of the project and adjusted wherever appropriate. The revenue contract may also include the variable consideration, and the variable consideration when the recovery of such consideration is highly probable. So the auditor has highlighted all the points related to the EPC contract in their key audit matter. Now, what auditor is doing, this is the only continuation of the key audit matter. They are saying that we will identify the performance obligation, we will evaluate the estimate cost to complete, we will evaluate the implication of changing the cost estimate and the cost to complete, and we will evaluate any variable consideration also. So then this was the specific fact in the first slide, which is disclosed by the auditor. And now the auditor is saying that I will do all these procedures. Additional procedures, what the client auditor is saying, we have also tested the effectiveness of the control. They also tested the control because we said that auditor has to test the key control around that, which we discussed. Here, the L&T auditor is also saying that we have tested the key control. And this is exactly as per the L&T's auditor report. They are saying that we have evaluated the key control around the performance obligations, estimation cost, okay, around the any change in the contingencies or any contingencies that need to be kept as a part of the performance of the contract or the progress of the contract, impact of changes any order in the transaction price and the related contract, and evaluation of the impact of the variable consideration. So auditor is saying that they have evaluated the control around all the aspects of the EPC contract, from the performance obligation, cost estimation, project progress, variable consideration, transaction price, any variations around that. They have tested the management control. And as we said, the management has to have a certain control in place to operate and effectively monitor this large turnkey project. So this is what the first auditor, this slide, the auditor has highlighted some facts. This slide, auditor is saying that we have tested control. And the last slide, auditor is saying that what we have done after that. So as I have explained the substantive audit procedure, auditor is saying that we have obtained and read the contract document. For each contract, we have also seen the change order, other document. We have identified the significant terms. We have seen the performance obligations. We have seen the changes to complete the work progress as a consequence of change in order, the impact of change order on the transaction price, any variation on the transaction price. The second last bullet, the compare the cost incurred with the company's estimate cost incurred to identify the significant variation. Check किया auditor ने कि भाई जितना estimate किया था उससे कम ज्यादा तो बहुत नहीं है. And the last point, test the estimate of the consistency with the status of the delivery of the milestone and the customer acceptance to identify the possible delays. So here what the auditor has checked, let's say when the customer के साथ जब agreement हुआ था, तो ये milestone, ये timeline पे agree हुआ था. So I am on that timeline. I am billing to the customer on that timeline. So all these parameters they have checked for the selected contract. So first the auditor is saying that it's a very critical area for the audit because it's involved judgment. Then they are saying that we have tested the control, and then they are saying that we have tested the various aspects in terms of an auditing the contract, reading the contract, change order, variation, changes in the cost, milestone billing, etc., etc. Maybe I will take a 15 seconds to 30 seconds pause to read this slide, and then I will move ahead. Moving to next slide, team. Now, see, this is all largely we discuss on the EPC business, okay? And I think all the fundamental aspect I have covered. Since many of you are also dealing with the real estate, okay, I have not covered much, but I have covered the one question on the real estate from the Ind AS 115 guidance note, where how generally you recognize the revenue for the real estate. Okay, the example read that the P Limited is developing the multi-unit residential complex. So residential complex bana raha hai with various units. It's a normal scenario. I'm going to the second para. Customer pays the deposit 10% entering into the contract and progress payment during the construction of the unit. जो normally industry में रहता है 10% पहले payment कर देता है बाद में during the progress of the project. Generally, this is the trend in the RERA also and required under RERA also. The deposit is refundable only if the entity failed to complete the construction of the unit. The P Limited retain the legal title until the construction is complete. Okay, P cannot direct the unit to the another customer in terms of contract. In addition, the customer does not have a right to terminate the contract unless the P Limited failed to perform the contract or deliver the unit. So, very simple scenario. Builder है, building बना रहा है, 10% advance लेता है और बाकी का he take during the progress, he take the deposit. Okay, legal title is with the builder. Okay, customer does not have a right to terminate the contract unless and otherwise builder does not perform the responsibilities. Okay, and customer cannot resell it, pledge it, because the ultimate title is with the builder till the time it is completed and given to the customer. So this is the effect. Now scenario A. If the customer default in his obligation by failing to make the promised progress payment as and when they are due, entity would have a right to all the consideration promised as a contract if it complete the construction of the unit. So customer hai, payment nahi kar pa raha hai, builder is doing the construction activity properly and the customer is not making a payment. The courts have previously upheld the similar right that the entitled developer to require the customer to perform subject to the entity meeting his obligation under the contract. The court is saying that by builder barabar building bana raha hai, customer has to make the payment. Now, how the builder should recognize the revenue? Okay, the question is how the builder should recognize the revenue. See, if the customer who were to default on his obligation, P would have an enforceable right to all the consideration promised under a contract if it is continue to perform as profit. अगर builder building बना रहा है तो उसको पैसा भी मिलना चाहिए. Therefore, the terms of the contract and the legal precedent indicate that there is a right to payment of the performance which is completed. And builder has to recognize the revenue based on the performance obligation done, which is the percentage of completion method. So here it fall कि builder building बना रहा है, okay, he is entitled to payment as per the terms and condition. Accordingly, he should recognize the revenue or the percentage of completion method, okay, if he continue to build the building. So the conclusion or the aspect here I want to understand is basically the real estate owner will determine revenue on the POC method if he continue to perform as per what he is promised, and if he has a contract with customer where he has agreed that you have to pay me on a timely basis. So this goes with the last condition which you have mentioned over a period of time. There is no alternate use of this asset and the builder is entitled for a payment. Now, slight change in a scenario. If the customer default on the contract, P Limited only has a right to retain the deposit. See, here what we are seeing, the builder is not entitled for the payment progressively. Scenario is changed. Builder ने ऐसा condition रख दिया, आप मुझे deposit दे दो, बाकी का आप काम करने बाद दोगे. So here, the real estate builder has to recognize the revenue once the unit is completed because he is not entitled to the progressive payment. उसको progressive payment completion basis पे नहीं मिलने वाला है. So he should recognize the revenue only when the unit is completed and it is being sold. So this is the only one example I have just tried to include here for the real estate perspective also. Okay, and whereby you have to see that the condition related to the progressive payment has to met and there is no alternative use of an asset, then the revenue has to be over a period of time, otherwise it has to be a point in time. This is only a definition of the contract asset where I have explained what is a contract asset. Let me just go to my another mathematics slide, okay, which is the unbilled revenue. Okay, this is the unbilled revenue. What we discuss is a contract asset, which is under Ind AS 115. So new term which has been given to the unbilled, which is the contract asset. So I have a revenue which is as per the POC method 54. I have only raised an invoice of 25. So remaining 29 is my contract asset, unbilled. And that is what is being here in this slide. I will just keep it open to read it for maybe 30 seconds to what is a contract asset. I have explained in a layman language what is a contract asset. This slide will make you further understand what is a contract asset. One of the another important feature of the EPC company is that their operating cycle for most of the companies are generally 12 months. Okay, generally 12 months may you prepare the product, sell the product, and you collect the money also. But for the EPC companies, these are large projects. Their operating cycle is not 12 months. Their operating cycle is the project cycle. Let's say if the project is a 3-year, accordingly, their project cycle has to be 3-year. Their operating cycle has to be 3-year. This is a disclosure in which we will deal with the disclosures while we see from the L&T. Okay. See, this is the extract of the L&T annual report, and I want to quickly run past through you on some of the disclosure under the revenue for the EPC business. The first disclosure is the revenue disaggregation in the operating segment and the geographical areas, because it is required by Ind AS 115. So the L&T is saying that I am doing the infrastructure activity under the various aspect, where infrastructure is this: hydrocarbon project, power project, heavy engineering project, defense engineering project. And I am doing in the domestic and the foreign jurisdiction. This is my largely analysis of the disaggregation revenue. Here they are saying that they have recognized the revenue of this much amount, okay, and this is in the over a period of time, and this is at a point in time. As I said, there are two methods of revenue recognition: over a period of time, percentage of completion method or input method, and the point in time, immediately while you deliver. So this is called the point in time. This bifurcation is required. This is the movement in their expected credit loss. This is the opening balance, and then provision reversal, their utilization reversal, return of bad debt, and the closing balance. Movement in the contract balances, as we said that there are unbilled, which is termed as a contract asset. In the advance from customer, which is referred as a contract liabilities. So this is the opening, this is the closing, this is a net increase, decrease. So another disclosure. This is the reconciliation of the overall contract price. How many fresh orders are received? How many have been scope changes, increase, decrease due to any forest impact? How many you have completed? And what is your open contract price at the end of the year? So this is the RECO, which is required for your all EPC project. This is very important disclosure, which was there in the slide, where let's say if you have a project cycle which is more than 12 months, because यहाँ पे क्या होगा कि आपका trade receivable current में ही रहेगा, because within your operating cycle है. But if it is likely to collected after 12 months, you have to mention that the trade receivable which are presented as a current, but how much will be collected within 12 months, after 12 months. See, this is not required where you have a 12-month as operating cycle, but where you have a after 12-month operating cycle or more than 12-month operating cycle, this disclosure is categorically required. Now, this was some of the critical disclosure which are required for the EPC companies. One additional topic which I would like to bring it to your notice. See, what happened is in the every EPC companies, the customer is always retain 5-10% as a retention money. Okay. So what happened is the customer will not pay 100% money. Customer will say that 5% I will pay you end of the project. You complete the overall project, 5% from the each invoice I will deduct. Okay. And I will keep it with me. I will pay you at the end of the project. So that is called retention money. Okay. Now, under Ind AS, okay, we need to evaluate, is this kind of an financing the client is doing? Because if they are retaining my 5%, is the kind of an financing I am doing to that? Okay. So what Ind AS says that if the contractor required amount to be retained as a part of their obligation in terms of an performance obligation. Okay, so it read like this. Okay, if the contractor required amount to be retained for a reason other than finance, company may conclude that contract with the customer does not involve any financing element. Okay, withholding with a specified percentage at each milestone intended to protect the customer from failing to adequately complete his obligation under the contract, and accordingly it's not a significant financing. So let's say everybody like to retain some amount so that customer or the contractor complete the work on a timely basis. If that is the ultimate reason, there is no financing, no further thought process is required. But if it is not for this reason and for some other reason, you need to evaluate this aspect bit more. This is the last topic, maybe the second last topic or last topic which I would like to brief is the variable consideration, which is the liquidated damages. I told you we have an example. Okay, so I read the example in the second para. Let's say in a sum contract, penalties are specified. In such a cases, penalty shall be accounted as per the substance of the contract. Where the penalty is inherent to determination of the transaction price, it shall form part of the variable consideration. For example, when the entity agreed to transfer a control of a good and services at the end of the 30 days for 1 lakh rupees. And if it exceeds 30 days, the entity is entitled to only 95,000. The reduction of 5,000 will be variable consideration. So what is your revenue? So your revenue will be 95,000 if you feel that you will likely to take more than 30 days and your historical trend is more than 30 days. But if your historical trend is 30 days and if you're likely to meet within 30 days, your revenue will be 1 lakh. So I think that's all are the critical aspect from my side on auditing the EPC companies, where we have discussed the risk in the EPC companies, how to address all this risk as a part of auditing aspect, and some of the technical aspect under the Ind AS in terms of it related to the EPC companies. So that's it from my side, and I'm open for any questions from the members that we need to consider for the today's session.
Thank you so much, sir, for such a detailed and very detailed and knowledgeable deliberation. I have received 4 or 5 questions till now.
Sure,
if you
sir.
allow, can I raise those questions, sir?
Yeah, please go ahead.
So first question is, what are the criteria for determining an EPC company and how to distinguish between this distinguish between them with the other similar companies?
See, there are, I will say there are not EPC companies, but an EPC contractor. Okay, the company might be doing the X kind of an work, Y kind of an work, or the same company may be manufacturing also, maybe the EPC work also. So it's not a companies which you can divide, but it's a work which a company is doing, you can divide. Okay, now how will you reach to a conclusion, is this an EPC project or not? So as I said, the EPC work or the EPC project will be a turnkey project where you involve from end to end, where you do some kind of an engineering in terms of design, you will procure the material and you will construct a certain site or certain kind of an project. So where you involve all this work, engineering, designing, procurement of material, construction, including labor, this kind of an work will fall under the EPC contractor or EPC kind of a job.
Yes, sir. Sir, another question is this relating to one member is saying tax audit points, disclosure notes for EPC companies. What points we should take into consideration while the tax audit relating to the EPC companies like the ICD inventory and AS and other stock related figures, what we have to check?
See, for EPC companies, okay, I don't see any so it's purely depend upon the accounting. Okay, first you have to get your accounting right done in the statement of the profit and loss, and the moment you get your accounting done right, your disclosure will flow from there only. So whether you take an inventory or maybe the any other disclosures, okay, first you need to ensure that your accounting done right, and then the disclosure will flow from that only. Maybe whoever raised this question need to be specifically discussed with respect to the any specific disclosures, how that impact. And I need the question is very right and important, but member can reach out to me on this with a specific disclosures, and maybe I also read through on that very specifically and come back to that member.
Yes. Sir, is the contractor expected to revise the estimated cost every year if the project period is say for 4 years?
Contractor is expected to revise as and when the contractor expect there is a change in the cost. They need not to wait for the year also. Okay, let's say it's a listed company and the listed company published the result for a quarterly basis. So they feel that if the cost is changed, they need to revise the cost on a quarterly basis. But the companies who are only doing the 1 year annual account, if they revise on an annual basis, if they see the change and they revise on the annual basis, I don't see any challenges on that, because your statement of profit and loss is prepared only once in a year, and the revision impact, if taken once in a year, should be okay.
Yes, sir. Sir, one member is requesting you to kindly explain the last slide once again with reference to the revenue recognition.
That was not the last slide, but I can go to the slide on the revenue recognition.
Relevant to the revenue recognition.
Yeah, so let me just share my presentation. So this is the slide which is talking about the theoretical aspect of the revenue recognition, where we can see that there are two methods, which is the input method and the output method. An input method, which is a percentage of completion method of the revenue recognition, and most of the EPC company will have a percentage of completion method. So this is the theoretical aspect. I am going to the mathematical aspect of this, where let's say my total revenue from the project is 100. Okay, and how I recognize the revenue on the EPC project on the percentage of completion? Let's say total revenue is 100, total estimated cost is 55, profit is 35. Okay, sorry, the profit here has to be 45, it's not 35. Then the total cost incurred on this project is, let's say, 30. Okay, the percentage of completion you will determine on the basis of the total cost incurred, which is 30, divided by expected cost, overall cost on the project, 55. So that your percentage of completion is 54. So you are expect to incur 55 rupees. You already incurred 30 rupees. So you have completed the project up to 55%. Total revenue of the project is 100. So then your 54% represent your 54 rupees of the revenue that you should recognize. So your P&L have an income of 54, cost of 30, and the profit of 24. So this is how you will recognize the revenue in the EPC contract on the percentage of completion method or input method under Ind AS 115.
Fine, sir. Fine, sir. Thank you so much, sir. Now we come to an end. Thank you so much on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India for your precious time, for your gracious presence at this particular webinar, and sparing your valuable time and enlightening all of us on various key considerations in the audit of the EPC companies. Thank you so much once again for sharing your knowledge with all our esteemed members. I also extend my heartiest thanks towards all the participants who have who are here for the last 2 hours for this particular session. Thank you so much, and very good evening to all of you. Thank you, sir. Thank you. Namaste.
Thank you to all of you. Thank you, ICI and all the participants. Thank you.
Thank you, sir.